I'm Teresa Matic with Resource Investing News. I'm down at the Vancouver Resource Investment Conference. Here with me today is John Kaiser of Kaiser Research. John, thank you for joining me.
Thanks for having me on.
So you recently gave a talk on the potential extinction of Canadian juniors due to regulatory overkill. Do you see hope for Canadian juniors in the future?
There is hope if a fundamental change is made to the regulations. We have tremendous regulations in terms of the reporting system, 43101, which provides a pretty good disclosure for the companies out there. The companies are doing real work. It's reasonably well presented. But where I see regulatory overkill is in the emergence of something they call the client relationship model, where they are becoming a nanny state with regard to investors. They are defining what is suitable. The brokerage industry is becoming very cautious about accepting unsolicited orders. And what's happening as a result of these structural changes in the financial services sector is that the juniors, especially the ones that are involved in higher risk, early stage exploration, they are turning into roadkill, and their access to capital is being choked off. And the retail investor who, unless they meet the accredited investor definition, which means that you have to be worth $1 million or more, with not including their primary residence, or have made $200,000 each of the last 2 years, they are not allowed to give money directly to the companies. I think this needs to be changed so that retail investors can give their money directly to companies so that they have fuel in the tank to drill those holes, to deliver those discoveries that we need to keep this sector alive during this cyclical downturn, which it is cyclical, but it may last too long to allow the survival of this Canadian institution of exploration juniors.
And is that challenge you just mentioned the biggest regulatory challenge for investors in Canadian juniors right now, or is there something else?
I would say this is the biggest challenge because the changes to the financial services sector are irreversible. And the juniors need to be able to access capital from a very broad base of individuals who understand that they are gambling. And the other interesting thing about when a retail investor does their homework and decides to give money directly to the company rather than just buying it in the market and selling it whenever, they end up with a much bigger understanding of the story. And when the story starts to gel, they end up talking. They become a dispersed promotional network and bring in other retail investors. What's missing now is a retail audience for the juniors. It has become a liquidity wasteland out there, and that needs to change, and only retail investors are capable of doing that.
Okay, and you've also said that the gold-silver bug narrative can be harmful to juniors. Why is that?
Well, the gold bug narrative says that gold's going to go up, and it's going to make worthless deposits worth an awful lot, and anybody who's got a gold project will see their stock price go up and be able to raise oodles of money. Except the standard apocalyptic gold bug narrative has an ideological taint rooted in market fundamentalism, where they're just whining about hyperinflation due to socialist policies and all this sort of stuff, and currency debasement, which, yes, these things can happen, and but when the gold price goes up like that, so do all the costs. So it doesn't really change the profitability of gold deposits to have the apocalyptic gold bug made positive. And it's now backlashed or boomeranged on them because the inflation has not materialized. The US dollar is rising. The American economy is starting to recover. So they've created a trap where one has extra reason to avoid anything associated with gold. So the poor juniors, even though they didn't really benefit from the gold bug narrative, are now being shunned because this bad gold bug narrative is on the rocks.
And in terms of other commodities, I understand that you've had a soft spot for diamonds. Is that still the case?
Yes, diamonds were the fabulous thing that developed in the bear market of 1989 to 92. Came out of nowhere. Over 100 companies ended up exploring area the size of Switzerland got staked in the Northwest Territories. Juniors exploded all over the world starting to look for diamonds. It produced real wealth. Canada's now, I think, third place in diamond production. And diamonds, they have a positive price trend because diamonds, unlike gold, doesn't really accumulate. All the diamonds, the trillions of carats that have been produced, they disappear. They're not there sitting in vaults waiting to be sold to the next closest bidder. And it tracks growth and prosperity of the world. So we could even see a modest economic growth happening, but so long as there is an emergence of a middle class and a wealthier class with a modest global economic growth, coupled with depleting diamond mines. There have been no really big discoveries in the last 10 years or so. So that means higher demand, higher prices for diamonds. And it is something that juniors can still sort of discover from scratch. The problem with diamonds is they are very exploration capital intensive. You need to spend $5-10 million before you can be even remotely confident that you have something that could be put into production. Whereas with a gold deposit, if you have 3 or 4 holes that scissor a deposit properly, you can already say, wow, this thing is going to be worth $200-300 million. Now we need $20 million to demonstrate it according to 43-101. Diamonds, it is not so easy to do that.
And on that note, it has been getting more difficult for diamond explorers to receive funding. Who do you see securing funding and moving forward?
Well, the classic example was Eric Friedland's Peregrine Diamonds, which I followed extensively since 2009 when they discovered the Chidliak diamond field. What they have appears to be equivalent to a 3 million ounce open pitable gold deposit grading about 8-9 grams per ton. Something like that would be worth $600-700 million. The company is market capped at about $40-50 million. And they need to do an expensive $15 million bulk sample. So what happened last year, they walked around the financial community and they said, yeah, we'll finance you at half the price. So the Friedlands said, well, at half the price, we'll do it ourselves. So they did a rights offering. The stock plunged 50%, and they did a guaranteed rights offering, 21%. And they themselves have ended up bankrolling the majority of this initial $15 million financing and own most of the warrants that will bring in another $15 million in April this year. So there's an example of how it's become very difficult to get capital from institutional audiences as well as from both sophisticated audiences and even retail investors, because a rights offering is something that retail investors can subscribe to. So they have had difficulty. They've had to dip into their own resources. Other juniors, Kennedy Diamonds and Mountain Province, have secured funding for their projects. Stornoway has secured development funding. Shoregold has managed to raise money for its Saskatchewan Fort de la Corne project. So there is funding available for the more advanced projects. For grassroots explorations, we need another major new discovery, and we need the Peregrine discovery to be acknowledged by the market as being worth a lot more than it is, because its valuation stands as a lid. Because if anybody comes up with similar results, 10 years ago we would have been ecstatic and bid the stock way up. But now you say, oh, those are just like Peregrine Diamonds. Well, look where they are right now. So this is the sort of cloud that's hanging over the diamond sector at the moment. And that's why Peregrine Diamonds is one of my top picks in the diamond sector going forward.
Thanks for joining me, John.
Thank you.
For Resource Investing News, I'm Teresa Matic.